Good evening, everybody. My name is Melina Dennebeim, and I am co-director of the Program for Financial Studies, along with Professor Harry Mamaysky, who we actually have as a featured speaker this evening, and as well as Krstovski, both Columbia Business School professors. And tonight we will have an interesting research TED Talk style presentation given by each, Harry and Kriste, on their current areas of study and research. And so as part of the Program for Financial Studies mission statement, we bring together the research and the practice of finance, economics, and data science. So tonight's research will be an interesting overlap of those three areas in terms of markets, data science, natural language processing, and also just the general finance trends. So I am delighted to introduce Harry Mamaysky, who most of you attending tonight will probably look very familiar to. And Harry is the faculty director of the Program for Financial Studies. He also directs the News and Finance initiative at the program. And Harry will be presenting first on predicting the oil market. Krstovski is a professor at the business school in the Decision, Risk, and Operations department. And he's also an associate research scientist at the Data Science Institute. So Kriste will be presenting second, and I'm delighted to kick it off tonight and hand it over to Harry. And again, this is a standard webinar format where we don't have the ability to see you, but you can see us, and you are welcome to pose questions as the presentations are moving along. We would just ask that you post them in the Q&A function at the base of your webinar screen. And at the end of the 20-minute presentation, then I'll facilitate the questions and you can feel free to ask more. And we will record the presentation so that those of you who miss it or would like to reference it will have the ability in a week or so to access the presentation. Okay, Harry, over to you.
Okay, thanks, Melina. Can you guys, I guess Melina and Kriste, can you see my screen that I'm sharing? Okay, yes, great. All right, hi everyone. I was just looking through the list of attendees, and I see some people who I know, which is great, so thank you for coming. So this is actually my first time presenting this paper. We've been working on this paper. My co-authors have presented it all over the place, but we've been working on it for quite some time, so I'm very excited to finally get to talk about it. So my co-authors on this project are Charles Kalamiris, who's a faculty at Columbia Business School, and Nita Sakir-Melik, who is an economist at the Federal Reserve Bank in Kansas City. So Anita is among the three of us really the energy market expert. And then there's me. So it's a paper about predicting the oil market. So let's talk about that. Why would we want to do this? So why focus on the oil market? Well, it almost doesn't need explaining, but I'll explain it anyway. Obviously, oil markets are important for oil producing countries and also oil importing countries, which means every country. Oil is an input to production and consumption goods, and of course the price of oil is a key variable for macroeconomic projections about future economic outcomes and risks. For example, here's a headline from the Wall Street Journal from just a few weeks ago that says soaring energy prices raise concerns about U.S. inflation and economy. So obviously, lots and lots of stakeholders care about understanding the future progress of oil markets. So again, to give you a size of the scale of what we're talking about, let's just get a brief measurement of the size of the oil market. So there's a headline from Bloomberg News recently that says that BP, so British Petroleum, says global oil demand has passed 100 million barrels per day, having fallen below that in the wake of the COVID-19 crisis. So what does that mean? Well, if we look at the price of a barrel of oil, looking at WTI futures of about $70, and we just do the math, it's 100 million barrels times 365 times roughly 70. So it's about a $2.5 trillion annual market, right? So that's real money. to give you a sense of how big that market is, it's almost as big as the crypto market, if you can believe that, which is kind of crazy. I don't know, and for one of those two markets to be that big, but anyway, that is what it is. So oil markets are very big, and they matter for lots and lots of people. So we might care about saying something about the future evolution of these markets. So why focus on forecasting? And what is even forecasting? We talk forecasting. Like, let's just write down the simple equation for what it means. Well, I'm a professor, so I need to show at least one equation in the talk. So let me show you what the forecasting equation. So the idea with forecasting is we're trying to make a decomposition of oil returns. So something that we don't know what will happen in the future. Say we want to look at the return on investing in oil futures from now until say 8 weeks in the future, and we want to decompose it into two parts. The part in green is the forecast. That's what we can say now about what will happen in the future. And the part in red is the part that we can say nothing about. So we're trying to decompose this future thing that we don't know into two parts. One part that we do know, and the other part that we really don't know, can't say anything about. So what forecasting allows us to do is reduce uncertainty. We reduce uncertainty because we figure out that, look, this oil return thing, which really is unknown, well, we can say something about it, right? We can forecast it a little bit, recognizing that there's a lot of it that we cannot forecast. So what does that mean? Well, it allows us to understand the economic drivers of energy markets. So we can think about forecasting oil returns or the returns of the oil majors of their stock prices, or we can think about forecasting some of the physical properties of the oil market, like production or inventories. All of that allows us to learn something about what drives energy markets to better understand them. And in fact, it allows us to understand, and this point extends really beyond just oil markets, how markets respond to information. So that's something economists and finance people care about. It's practitioners certainly care a lot about it, is to understand when new information comes to markets, how do markets respond? Like, what do they respond to in that new information? How quickly do they respond to that information? So we'll be able to say something about that. Now, when we talk about forecasting, there's two important things to think about. One is what people call in-sample forecasting, and one is what people call out-of-sample forecasting. So just what do those things mean? Well, in-sample forecasting basically says, look, we have several decades worth of data. Let's just use like all the data that we have and understand within the data that we have, what relationships prevail. So that's using all of our data. That's called in-sample. But the other way to think about forecasting is out-of-sample. And what that means is if we are trying to make a forecast for 8 weeks ahead, starting from today, or for the next 8 weeks, we're not allowed to use future information. Now today, of course, it's easy because we don't have future information. But when we're doing analysis of a forecasting methodology and we look back in time, we do have future information. And so when we're doing in-sample forecasting, we're basically allowing ourselves to use all of the information. When we do out-of-sample forecasting, if we want to do an out-of-sample forecast of the 8-week ahead return of oil starting in January of 2010, we just have to be very careful not to use any information after that date, to only use information that's prior to it, so we're not using any future information in our forecast. And one of the important points that we're trying to make in this paper is that there's a big distinction between in-sample and out-of-sample forecasting. And we're not the only people to make this point. This is a point that's been a big focus in the academic literature for the last several years, or even maybe longer, which is that we can have these wonderful in-sample forecasts, and when we take them to practice, they just don't work very well. And the closest we can come to take it to practice in our statistical analysis to do this out-of-sample forecasting. So I'll talk both about in-sample and out-of-sample forecasting of energy markets and see what we can say about those things. So what do we do in this paper? What's interesting? Well, the real innovation of our paper, well, I would say there's two innovations of our paper. One is that we take the out-of-sample stuff that I just mentioned really, really seriously. That's one. But another innovation of our paper is we construct a a set of new natural language processing measures, so text-based measures, derived from the analysis of a large collection of news about oil markets. So we create these new measures based on news articles about the future of oil markets. Now, why news? Why does that matter for oil markets? Well, we have, in addition to our news-based variables, we have a lot of other variables, right, that people have used to forecast energy market outcomes over the last, many decades. There's been a lot of interest. But the feature of a lot of these variables is they're a little bit backward looking. They're like, what happened in the past? What happened to oil future returns in the past? What was volatility like in the past? What was production like in the past? So all of these backward looking measures. And if something is happening in the world, like think back to, January and February of 2020, when people started first discussing, this new novel coronavirus. So none of our backward-looking measures in the oil markets would have known anything about those discussions. But if you look at news, of course, people were discussing it in the news. And so the question is, can we tease out some of that information that's embedded in news that's sort of, much more real time to learn about, the future evolution of energy markets in a way that, the traditional series cannot inform us about. So that's really the heart of the question we're asking. And we focus on forecasting several different things. We forecast market outcomes, which means things that have prices. So, for example, oil future returns and changes in the oil spot price. We also look at forecasting the returns of the large energy companies like World, Shell, BP, and ExxonMobil. And we also look at forecasting the realized volatility of oil prices. And each of these different variables that we're trying to forecast has its own set of people who are interested in it, who want to understand that particular aspect. And in addition, we also forecast physical outcomes. So here we're looking at forecasting production of oil and change in oil inventories, both of which are, again, quite difficult forecasting problems. So we throw an enormous sort of the kitchen sink of forecasting variables. In fact, truth be told, we had fewer variables than this, and we submitted our paper to a finance journal who very promptly rejected our paper, unfortunately, but with very nice constructive feedback. And one of the feedback was like, look, you ignored a whole bunch of forecasting variables. So we took all of those new variables that they suggested and we incorporated them. So there's not really time to get into all of these things. Let me just mention some of these variables. So we have variables that we're going to use to forecast these energy market outcomes that come from broad markets, like, implied volatilities and treasury yields, et cetera. Also broad macro variables like industrial production, this weekly time trend, basically, which controls for the possibility that, some of these energy market outcomes have been sort of rising or falling over time. Information from physical oil markets like production inventories, and then a whole slew of information from energy markets themselves. How sensitive are oil prices to inflation, how liquid are futures, what's open interest in futures. I mean, just really many, like everything we could think of that existed in the literature prior to us, we sort of threw it in as a forecasting variable to see what it could say. And the things that are in red here are things that speak about risks in oil markets as opposed to forecasting up or down moves. So, okay, so that's like the kitchen sink of forecasting variables. What's new? Okay, so what's new in our paper is we analyze roughly 2 million energy-related articles from our news archive, which is coming from Reuters, over about 20 plus years. And text analysis, you could kind of, really play it up and say, oh, we're doing, artificial intelligence to text and all this stuff. And, at the end of the day, all we're doing really is we're going to be counting words and basically calculating correlations of words across different articles. So we're really just, it's not so much AI, it's just treating text as another data set and seeing what it can tell us. And we looked at multiple dimensions of news stories, for example, the number of articles that were written and entropy. So entropy is a measure of the unusualness of articles. This is something that I've done in past research work that we found and ongoing research work that we find to be very important for explaining and forecasting market outcomes. We look at the frequency of topics and topic sentiment. I'll talk about those in a second. So we basically say, okay, look, we get an article, right? And we cannot, computer technology, like our algorithms, are really not at the point where a computer can read an article and extract from it, nearly as much information as a human being can. Like, a human can understand 100 times more about a given article than a computer. The upside of a computer is it can instantaneously read tens of thousands of articles. So what we need to do is take each article and sort of distill from it a bunch of numerical measures that we can then take to the data. And that's really what we do. So let me just mention a few of our measures. So one of the measures is the sentiment of articles. Okay, how do we get sentiment? It sounds very complicated. Well, we use something called the Lawford McDonald Dictionary, which is a spreadsheet that tabulates positive sentiment and negative sentiment words. Where does it come from? Well, these two researchers from Notre Dame University read thousands and thousands, I don't know how many, I'm guessing thousands and thousands of corporate annual reports. And in reading them, they basically hand identified negative and positive words. So what are these words? Well, here's an example of some of the most commonly occurring negative words. It's things like loss, losses, adversely, against, impairment, closing. So these are bad words. And here's some of the most frequently occurring good words, things like effective, benefit, gain, greater, best, gains, successful, favorable, so you see, you see the distinction. Okay, now, so how do we measure sentiment? Well, it's not rocket science. It's hardly science at all, as a matter of fact. We take a sentence and we count the number of positive words, and then we count the number of negative words. We subtract one from the other, and we divide it by the total number of words in that sentence or in that article, and we can assign a sentiment measure. So let's do an example. Here's a little article. It says, I made it up, but to make a point. So it says the firm's stock market losses can only be explained via anticipation of greater future litigation risk. Okay, let's apply our rule to this. So how many positive words? Well, it turns out greater is actually a positive word, so that one positive. Losses and litigation negative, so 1 minus 2. And if I counted correctly, there were 16 words. So this has an article sentiment score of minus 0.06. Now, I actually made this example a little bit on purpose, because clearly greater here is not a positive word, right? Like greater here, if any human reading this understands that the fact that the word greater is in this sentence does not indicate anything good. It's because people think there's a bigger chance of litigation risk than they thought before. So this method is not the most state-of-the-art method. There are many more sophisticated methods. In fact, Kriste and I are working on a project, and I have another project where we're applying some of these more sophisticated methods that will allow you to take into consideration context. So it would understand that the word greater as used in this sentence actually does not mean a positive thing, but that's an aside. That's for a later date. What I want you to take away is that this is a very simple approach, and it works pretty well. When we compare it to much fancier methods that really involve AI and neural networks and all this stuff, like those work a little bit better, but this one holds its own. It's not bad. So we use a simple method, easy to explain, and it's pretty good, although not perfect. By the way, if you want to see some of these words, I give you a link. Melina can help us hand out the slides. Here's a link to the web address. So you can download the spreadsheet and you can look at all these words. They're all just tabulated there and use them in your own analysis. Okay, so the next thing we do is we classify our news articles into topics. Okay, so what we sort of understood early on is that, look, we have 2 million articles about the energy market. Not all of them are going to be about the same thing, right? So some can talk about companies, others can talk about like energy generation, others talk about the E&P, like exploration and production sector. So they're not always about the same thing. Okay, I won't talk, we don't have time, but let me show you a picture. So how do you do topic analysis? The basic idea, there are many algorithms, and people keep on inventing new ones. I will also admit that Kriste and I have another paper with some authors where we invented a new topic algorithm, but they all do sort of the same thing. They look for words that co-occur with each other. And then they collect those words into little clusters of words. and those clusters of words form topics. So here are a bunch of words that co-occur together. So it turns out when you analyze 2 million of these energy articles, words like Brent, barrel, crude, oil, refinery, OPEC, all of these really tend to happen together, tend to occur at the same time. Similarly, words like carbon, climate, green, emission, environment, pollution, global warming, those words tend to co-occur together. And so we have these clusters of words, and we attached a label to them. So we said, okay, if an article has a lot of words like carbon, climate, emission, environment, green, pollution, et cetera, we're going to say that's an article about the environment. And then if we have something that mentions words like pipeline, WTI, Gulf Coast, West Texas Intermediate, midstream, heavy Louisiana sweet, that's probably something about the crude oil physical market, right? So we created these categories, and then we combine sentiment, the measure that I just showed you, with these categories to assign what we call topical sentiment, to say that, okay, in news articles about the environment, we're seeing good or bad news. In news articles about refining and petrochemicals, we're seeing good or bad news. And news articles about oil companies, we're seeing good or bad news. So we can basically classify particular topics of discussion about the energy market into good or bad news by combining this topic model and sentiment model idea. Okay, I'll skip this. It's some examples of headlines. I see that I have no time left. So here's what we're going to do. We're going to forecast these 8 variables: future oil returns, stock returns, volatility, oil production, inventories, using our forecasting variables, of which we have like, I don't know, 60 or something, just a whole, kitchen sink of variables. So what are the problems with this? Well, the first problem is, how do you choose a subset of all of these 60 variables, because you can't use all of them, that happens to be good at forecasting each of our different outcome variables? Like, which set of variables are good at forecasting oil production, and which set of variables are good at forecasting realized oil market volatility, right? Maybe different sets of variables. So we address that problem using a technique called forward selection, which I'll just gloss over, but we solve that problem. The second problem we confront is, okay, we've selected out of 60 different explanatory variables, like 5 good ones. And the 5 good ones in our full sample, are really good at explaining what happens to the returns of Royal Dutch Shell stock. But how do we know that, like, we didn't overfit, right? Like, we were choosing 5 out of many, many variables. How do we know that those 5 aren't spuriously correlated with the Royal Dutch Shell? So what do we need to do? We need to run some simulations of our model to adjust for the possibility that we're finding spurious correlations, because we're choosing 5 or 6 forecasting variables out of a set of 60, and that introduces a lot of statistical issues which we control for. So that's a win. And after doing all of that, we find that our traditional and text measures can forecast all of the energy market outcomes effectively. So we're very careful about our econometrics, our statistical approach, and we find a lot of evidence that these things forecast energy market outcomes, including our novel text measures. So this is like a new contribution to the literature. Okay, so show me the money, right? We're ready. We're ready to go trade and make money. But wait, because we haven't done our out of sample testing. So right, which is what people would actually do. Like, we've been sort of using implicitly future information. Let's see, how well does this do if we don't use future information? So that's the next challenge. So the next challenge is, let's forecast out of sample. And here, and for the sake of brevity, I will just summarize very quickly, we don't do quite as well as in sample. We found it very, very difficult to select a model using only past looking information that was really good at forecasting any of these energy market outcomes, despite the fact that in sample, with very, very rigorous statistical analysis, we saw that a lot of variables were really, really good at forecasting energy market outcomes. But out of sample, it doesn't work. Why? The reason it doesn't work out of sample is because the world changes, right? And this is like the crucial thing you sort of need to realize. Like, variables that were good at forecasting oil markets in the 90s were not the variables that were good at forecasting oil markets in the 2000s, were not the variables that worked during 2010, were not the variables that are working in 2020. So the model somehow needs to take into account the fact that the world is changing over time, and that the 5 variables we choose in the full sample may not be the 5 variables that work in any given time frame. They're the things that worked on average over the whole time sample, but they may not be good at forecasting at any particular point in time, and that's really fine. So then what we finally do is, and this kind of works, is we tried all possible 2 variable models. So how many variables? We have 60 variables, so we can choose one of 60 variables and then one of 59 variables. And so we form like several thousand possible forecasting models. We check how do all of them work in subsamples of the data. And we find that some models work really well in subsamples. So at some point in time between, say, 2000 and 2003, what was really good at forecasting, I'm going to make this up, oil spot price changes were lagged realized volatility and the illiquidity of oil futures. I'm sort of making that up, but those variables changed in the future. But what we do find is there's some stability here. So variables that are good at forecasting these energy market outcomes in 1 3-year period actually tend to be more similar variables that are successful in forecasting in the next 3-year period. So that stability of forecasting variables gives us a little bit of a clue that we might be able to do some effective forecasting in energy markets, but we just have to be really careful and clever about how we're selecting the forecasting variables, recognizing that they change over time, and that's like the key dynamic in this data is the world is changing all the time. Okay, so to conclude, we do this new model, millions of news articles, we have these cool text-based measures, I showed you a little bit of them. These are good in-sample forecasters, much more challenging to forecast out of sample, where we can't use future data. But there's some evidence of this persistence that variables that forecast well in 1 3-year period tend to do okay in the next 3-year period. So there's some persistence. So the takeaways are, we should look at these novel, unique data sets for forecasting in finance and economics, but you have to be really, really careful in interpreting in-sample results. And this is kind of a theme that I think economists and financial economists have really come to over the last several years of work, that like we can get these beautiful in-sample results, but they just don't work really well out of sample, and we have to be cognizant and sort of modify our approach to take that into account. So I know we don't have now much time for questions, but maybe if we have like just 2 or 3 minutes, I'll stop and we can have a few questions. If there are. If not, we'll hand it over to Kriste.
You can write them in the Q&A function. Don't see any questions yet. Okay.
Okay, so 2 questions. Aya is asking, have you looked at stable variables that function in a way that if you add in-sample versus out-of-sample, they improve the model? Perhaps to give us. Yeah, so that's a really good question. So Aya is asking, are there some variables that seem to be very stable? There are some variables that are very stable for some of for some of the things we're trying to forecast, and we have a whole section in the paper that looks at that. For example, one stable forecasting relationship, not surprising to anyone who's ever done financial forecasting, is that lagged realized volatility is good at forecasting future realized volatility in like all sub periods, right? That's not a novel discovery, but that's one example of something that's very stable. A lot of the other stuff isn't that stable. So Helgi is asking, is in-sample basically backtesting? Yes, it's like so backtesting, I would say, is like, let's build some kind of strategy on the back of our findings that say is a good investing strategy on a risk-adjusted basis, and so that's related to what we would call out-of-sample forecasting. So in-sample means you're using like all the data, and so like when you have a model prediction in 2010, you have to keep in mind that model prediction, the coefficients it's using to make the forecast, is actually using information from 2011 and 12 and 13 and 14, et cetera, into the future. In-sample means when we're making a forecast from 2010 forward, we can only use data through the end of 2009. So we're not allowing ourselves to use any future data, which is, of course, how all of us live in reality. We don't know the future, fortunately, probably. So we have to only base our decisions on what happened in the past. And I cannot comment on, Terry, on whether our model, will agree or disagree with Jamie Dimon. probably has a much bigger team of energy forecasters. So I would not be willing to challenge the entire JP Morgan knowledge base on this call. Well, that'll have to wait for another day. Okay, so you can send me emails and ask, but let me hand it over to Kriste because I don't want to monopolize the time. So thanks everyone for listening, and I'm going to stop sharing and hand this over to my colleague. Okay, bye.
Thank you, Harry. Great. Kriste, you're on mute.
Apologies, everyone. I guess I have to start all over again. Hi, everyone. First of all, apologies for my hoarseness as I suffer from a sore throat, which has nothing to do with the COVID-19 virus. Thank you, Melina and Harry, for the invitation to present. Hi, everyone. My name is Kriste Krstovski, and I'm an adjunct assistant professor at the business school and an associate research scientist at the Data Science Institute. And the title of my talk today is Assessing Corporate Climate Through Big Data. And as part of this talk, I'll be presenting early stage results of an ongoing project with Yao Lu, who is a faculty at the sociology department here at Columbia, and the following research assistants: Siddhant Sadvar, who is currently a PhD student in statistics at UIC, Connie Xu, and Ling Sun. So the labor market inequality by gender and race has largely persisted in the United States. And this is despite many efforts made by women and racial minorities. For example, the significant increase in education levels, workforce experiences, occupational differences, and others. And basically, there have been numerous studies performed on this topic from various perspectives, such as wage gap, employment rate, retention, etc. And simple search on this topic, which is what I did in the preparation of this presentation, reveals various such studies and findings. And in fact, some of these studies even indicate that this inequality has increased. And that's especially the case for college-educated workers. So current understanding of the involved factors that contribute to or help reduce such inequality has been limited by the use of conventional data and methods. And conventional data mostly comes from surveys, and that's not sufficient because surveys often don't provide sufficiently detailed information on long-term career trajectories in company environment. And surveys generally don't provide a sufficiently large sample that permits this robust disaggregated analysis by racial groups. And so in this project, we would like to gain new insights about the labor market inequality, especially for the high-skilled workers, using big data. And so in this project, we use two data sets. We have online resumes, which provide more detailed information on educational and long-term career trajectories of American workers. And with this data, we would like to answer questions such as, how do career trajectories of high-skilled workers vary by gender and race? And also, how do different career trajectories affect gender and race inequality? So that's on one end. On the other end, we also have an online collection of employer reviews, which actually helps us assess the individual's work environment, as we are referring to as corporate climate in its practical meaning in the business world. And the consequences, so what we would like to do is help us assess these individuals' corporate climate and the consequences on their careers. And we would like to ask questions such as, how does the corporate climate in terms of gender and race discrimination shape individual career trajectories? And how does the role of corporate climate differ by gender and race? So to summarize, or to recap, we have online resumes and online company reviews. And from the resume, we would like to learn about the career trajectories. And from the reviews, we would like to learn about the company environment in terms of gender and race discrimination. And basically combining these data sets together will allow us to assess individuals' work environment and its consequences for career outcomes. So in the remainder of this talk, I will be focusing on the company reviews aspect of the project. And here, the main question that we are trying to answer is, how do we assess corporate climate in terms of gender and race discrimination using company reviews? And so ideally, what we would like to be able to do is to develop a reliable way to quantify gender and racial environment in the company, discrimination in context of discrimination, in the company with minimum human supervision or intervention. And so for this purpose, we use company reviews from Glassdoor.com, and I assume that most of you, if not all of you, are familiar with this website. This is an online platform where employees, current and former employees, can anonymously review companies. And also you can anonymously submit and view salary information, amongst other things. And it's also known as a job seeking platform. So we focus on US-based companies that have more than 10 reviews. And we cover a time period from January 2008 till March of 2019, which gives us roughly around 6.2 million reviews. Here's an example review. So each review consists of 4 textual fields, which the reviewer populates when they write the review. So we have the title, we have the pros section, the cons section, and the advice to management. And reviewers also provide the overall star rating for the company, which is on a scale from 1 to 5. And in addition, there are these different workplace factor ratings, or they're also referred to as workplace attributes, that the reviewer can rank the company on. Those attributes are work-life balance, career opportunities, compensation and benefits, senior management, climate and values. And starting from October 2020, this was long after we initiated this project, Glassdoor actually added an additional workplace attribute, which is referred to as diversity and inclusion. So reviews can vary in many different ways. They can vary in terms of their length. They can be lengthy, or they can be very concise. They can also vary in language. And interestingly, the majority of the company reviews are with 3, 4, or 5-star ratings. And given that reviews are anonymous, one may assume that the reviewers mostly rant about the companies, but in fact, most of the reviews are positive. And this is something that Glassdoor has acknowledged in the past, stated that their average company rating is 3.3. Now, from the company climate perspective, and whether, for example, gender discrimination is present within the company, an exemplar review that most of us would like to see is a review like the one on this slide, this example that I'm showing, where the reviewer gave the company a 5-star rating, and under the pros section, they have written, which is what I've sort of like framed with red here. Loved, and I'm just going to read this excerpt. Love the culture, people are friendly, especially if you're a designer. You get treated really well, awesome for gay parents, women are treated well, and they have interesting international policies. Another example review that everyone would like to see is reviewed like the following one. So in this case, the reviewer gave the company a 1-star rating. And they, under the cons section, they have written, working for small-minded managers, content to lose business, senior managers routinely sexually harass women, and whistleblowers are terminated. So in this case, actually, there are other troubling issues, like snakes coming out of the ceiling, which it's a very serious issue. But nevertheless, given that the race and gender discrimination is a concerning topic, we expect to see that such topics directly reflect on the overall company rating. However, amongst our initial findings, we noticed that the overall star rating of the company doesn't significantly reflect on whether there is a race and discrimination happening in the company. So we noticed reviews like the ones that I'm presenting here. So both of them gave a review of 4 stars to the company. And in the cons section, they have written down. So the first reviewer has written down lack of women in management, executive positions, manager level and above. If you're female, not the plan to be at. And the other reviewer wrote, women generally make less money than men for the same job, advancement opportunities are slim and or non-existent, very few minorities, and so on. So actually, on our further analysis, we have revealed that around 18% of the reviews where the discrimination topic was the dominant topic in the review, the star rating was actually either 4 or 5. So I should mention here at this point that we performed this analysis using a machine learning approach that lets us infer the probability of a set of topics related to gender and race discrimination being present in the review. So this is in line to topic modeling that Harry talked about in his presentation. And so what this tells us is that simply relying on the star rating in combination with whether discrimination topics are present in the review won't really help us reliably assess the company's corporate climate in terms of gender and race discrimination. So this makes the question of how do we assess corporate climate in terms of gender and race discrimination using company reviews more challenging to answer. So in order to assess corporate climate in terms of gender and race discrimination, we will need to extract reviews related to gender and race discrimination. And so the way we do that is we start with keywords which we extract from official government documents, such as the US Equal Employment Opportunity Commission reports. And while it is important to start with good sources of information, having just these keywords is very limited. And so in addition, given that these are basically government documents, the vocabulary that will be used to explain different types of discriminations in these reports would be, the vocabulary that would be used would be very formal, while Glassdoor reviews are more on the informal side. So what we do is we use these official keywords to learn of other keywords present within the reviews using distributed representational words. So what is distributed representational words? So this is basically a data science approach. It's sort of on the intersection between natural language processing and machine learning. And what I'm going to do is I'm going to briefly describe this approach. So this approach is used to represent words as vectors. And the representation is based on this distributional hypothesis, which actually comes from linguistics. More specifically, it comes from the semantic theory of language, which states that words that are used and occur in the same context tend to have similar meaning. Or as it is succinctly summarized in this quote, a word is characterized by the company it keeps. So what this approach basically does is it creates vector representations of words that maximizes this conditional probability of having the word being found in a certain context. And so, for example, here we have the word racism, the conditional probability is like defined as what is the probability of having the word racism given its surrounding words such as undertones, discrimination, workplace, and so on. And so in the second example, for example, we have also the same word racism, but here the context is different, but nevertheless, the objective function is the same. So using this approach, we're able to extend our initial vocabulary of keywords by finding words which are similar in their meaning to our initial keywords extracted from the EEOC reports. So I should mention here that in addition of using distributed representation words, we also use additional NLP approaches to refine these keywords. So ultimately what we have now is a distributed representation of words, which lets us also represent reviews as vectors. So we take each review, we take the words that are present in the review, we take a sum of their distributed representation vectors and we average them, and that becomes our vector representation of the review. This approach also allows us to basically derive a single vector representation of gender and race discrimination keywords. So what we do, we basically generate a semantic representation of what we define to be a gender and race discrimination using keywords. And so ultimately, this allows us to measure how semantically similar the review's content is to our representation of gender and race discrimination. Aside from keywords and distributed representation of documents, our current approach also involves additional machine learning and natural language processing approaches, such as discovering race and gender discrimination specific topics which I mentioned earlier in one of my previous slides. And so again, this is this is basically topic models, which is what Harry talked about in his presentation. Now, having race and gender discrimination topics, what we are basically able to do is we are able to complement our previous representation, which uses word ordering. So the way that the distributed representation works is that it looks into the actual ordering the words, versus the topic approach, we basically obtains information from the whole review. So in addition to this approach, we also measure review sentiment, and we finally use extracted reviews to rank companies. I should also mention here at this point that along the way, we also perform various tests, which also include annotation of extracted reviews and evaluation of the different methods. So we kind of created this pipeline where we, along the way, across different segments or across the different approaches that we use, we basically do annotation and evaluation. Okay, so lastly, or how is it that how is it that our approach works? So what I would like to talk about is how do we currently evaluate our automated approach for ranking companies? Given that this is an algorithmic based approach, and the actual process heavily relies on algorithms, it's natural to perform some sort of an evaluation. Although we could just simply explain the methodology as other algorithmically based rank lists do and be done with it. So this is also an option that we're given to us because we simply derive this rank list and we can just present it and be done with it. But and that's basically what Glassdoor's rank list of companies is actually doing. So this rank list of companies is known as the Glassdoor best places to work. And even though they've explained the methodology, they don't really dive into showing any evaluations or any detailed information as to how the algorithm, how does it work even on a small annotated set of reviewed companies. Under the documentation, they just said that Glassdoor's proprietary awards algorithm also takes into account what employees have to say that shows winners truly outshine the rest. Now, in general, algorithmic approaches are evaluated using ground truth, which in our case would mean going over company reviews, check to see if they contain race and gender discrimination reviews, create a list of such companies, and basically this process is very time consuming. It's a very pesky process to basically go over hundreds of thousands of reviews depending on the company. So what we currently do, what our current approach to evaluation is doing is basically we use two types of rank lists. We have a list of good companies, which is the rank list generated by Glassdoor. And we have a rank list of bad companies, which is composed from the big business bias report. So this is a report on employment discrimination and sexual harassment in large corporations. And what the report does is basically examines and rank companies by the number of employment discrimination cases brought against them, whose outcome is actually part of the public record. And so the cases include private lawsuits, they include cases brought by the EEOC, and also cases brought by this Office of Federal Contract Compliance Programs. And so we have these two rank lists, lists of good companies and lists of not so good companies or bad companies. And so what we are doing basically, actually at this point I should mention that even though our methodology doesn't overlap with the methodology that, for example, Glassdoor is using, or the methodology that the big business bias report is using, we assume that across reviews of good companies, there should be ideally none or only a few reviews that mention race and discrimination. And in the case of bad companies, we should expect the opposite. So how do we actually evaluate our approach? So we use this rank list as sort of like a ground truth of what is a good company and what is a bad company. And we basically evaluate our approach based on how well does it rank bad companies versus good companies. And so this is sort of like what Google does when retrieving relevant and irrelevant documents to your query. So whenever you enter a query, what you would like to see is all the documents that are ranked in the first 10 ranks to be relevant to the query, while documents that are ranked further down on this rank list to be less relevant to the query. So we want to see good companies be ranked at the bottom of this list, because again, this list is a list where companies that have, where companies in their reviews have lots of information on gender and race discrimination, they're basically ranked really high. And so again, bad companies should be ranked really high, good companies should be ranked at the bottom of the list. And so what our early stage results show that our approach ranks bad companies much higher than good companies. And here I'm showing results using this measure, which is known in information retrieval as average precision. And this is really actually what we would like to be able to achieve. And so looking at this result, it kind of makes sense that we see that for the average position of good companies, ideally we would like to have that value be really close to 0, but that's not the case. And that kind of makes sense because we saw that many actually good reviews may contain bad information about discrimination. Now, when it comes to the bad business bias rank list, we know that this list was created using only information that is publicly available. So in a sense, that's sort of being considered and being covered in this case. So I don't know how much time I have left, but with that, I would like to wrap up my presentation and happy to answer any questions that you may have.
Great, thank you so much, Kriste. We do have a question. In terms of comparing the good and bad companies to work for, do you need to compare the results based on gender from women to those from men?
Melina, is this a question posted? I'm looking at the...
It's posted. It's the second to last question.
I can't tell if you might combine the data with other reporting. Sorry, can you please... I didn't quite get that question. So what was the question again?
Sure, it's the question. I'm just reading it from our Q&A chat, but if you want, we can go in reverse order. So if you'd like to read Aya's question, you can go ahead.
Okay, so Ayed is asking, I can't tell if there's any work being done to evaluate the relative levels of racial reform. You might combine this data with other reporting of racial diversity to evaluate complaints. Yep, we can do that. And also that would enable you to rank goodness, badness, given a fixed level of diversity. So firms aren't being rated lower for actually having a no. Yep, I mean, there are many things that we can do and that can be combined in this study. So should I proceed with Terry's question? I think that
Sure.
In comparing good and bad companies to work for, you need to compare those results from women, from women to those from men. To work for, you need to compare those results from. I don't quite understand this question really. Comparing good and bad companies to work for, you need to compare these results from. Yeah, I'm sorry, but I don't quite, and maybe.
Because I think he's asking whether like some companies are bad for, for women to work at and other companies are bad for men to work.
Oh, right, I understand. Yeah, I mean, we can do that. Even though here, what we are trying to do is, the gender information we are getting from the online resume. So there isn't really any need, but this can be extended to basically depending on whether the review is the reviewer is making these observations from a women's perspective or a man's perspective. Yes, exactly, we can do that.
Okay. I think that's all the questions as of now. So I think if they let me just wait one moment. Okay. Yeah, so I think we can wrap up. I think that was a great combination of presentations. Thank you so much, Harry. Thank you so much, Kriste. This was a great evening of two different topics, but also a lot of interesting data analysis and methodology behind each. So thanks everyone for coming and attending the No Free Lunch from the Program for Financial Studies at Columbia. And we wish everyone a good evening.
Everyone.
Thanks, everybody. Bye-bye.